Hey all, welcome to this episode of A Good Problem to Have. I'm your host, Tyler Olson. I was thinking about incentives today and wanted to talk with you all about the incentives you should be aware of amongst the people in my trade, financial planners and advisors, and other people in the financial industry. Um, the the services provided by people like me, they obviously carry value to varying degrees depending on your needs and disposition. Um, so obviously getting paid for our work, just like all you in medicine, you should be paid appropriately for your work. Um, that's fine, right? But knowing what is the source of revenue, how and why is relevant to being able to evaluate its impact on the services and the advice that you're getting. And so that's why I wanted to talk about this. There's one of the reasons why it's confusing too is because there's many ways in which people in the financial services industry get paid. And I wanted to outline a few primary ways. The way in which you buy insurance products or investment products through insurance agencies or what are called broker dealers for the investment side. That's basically selling a product and getting a commission for it. So if you go to an investment advisory firm, or I shouldn't call it an advisory firm, I should call it a broker dealer, and you're like, I want to invest. Like, say you go to an Edward Jones. And they're like, oh, great, you can open up a Roth IRA and we're going to put you into the Investment Company of America, which is a fund of the American funds. And you put in $5,000. That's how much you could put in for your Roth IRA. And then American funds charges you a commission. So you don't put $5,000 into the investment. What ends up happening is you get 5% off the top. So instead of $5,000 going to work for you, it's more like $4,750. So you paid a $250 fee or commission in order to buy that product. Most of that $250 goes to the registered representative, which is what they're called when they sell an investment product for commission. They made $250, or maybe a little less than that, maybe like $240, $230, and it gets divided up between the firm owner and the advisor themselves, the registered rep. So there's money being made by the sale of that product. Similarly, say you go to an independent disability insurance agent, and I know some really great people that know how to help physicians with this. They get paid on commission. Like I think on Larry Keller, Michael Relvis are the top two I think of. I've known them for a long time, and they work off commission. If they end up selling you a policy and the disability insurance premium, let's say it's $10,000 for the annual premium, they're probably going to make somewhere around half of that in a commission. Maybe less than that. It might be 40%, could be 60%. It depends on the insurance company. But they, they'll make between $4,000 and $6,000 on the sale of that policy. So now in the case of both of these people are not entities, they're humans, right? And both the case of of like investments and like insurance people, they should be educating you and helping you to make a good decision and providing services that you need. I'm not going to speak ill of any particular compensation structure today, just because I think that there is genuinely a time and place for each type. But these ones are the most transactionally based. So it's like the focus is on this product. And what that does is it takes the center of the conversation. It tends to lead away from you, the person as a whole. And it doesn't mean that it's bad advice. It just means that the financial incentive is drawn toward a particular product. And it's on the advisor, it's on the agent to be able to make sure that they're doing right by you and that they're actually spending the time and effort to give you good advice and to get you what you need. In the case of disability insurance, there is a lot of work that goes into building the right policy and making sure that they're helping you navigate the insurance underwriting process carefully. And so if you're working with a good agent, it is well worth whatever commission that they get paid. Now, of course, you don't pay this out of pocket. And that's why this is a little bit unseen, because it's not like you're like, well, it's time to pay Larry $4,000. It's time to pay Sarah, the registered representative, $250. You don't write a check and nothing comes off your credit card statement. It just happens internally. It does have an impact on what the policy is costing you or what the investment is costing you, because in the end, they're not working for free, and neither is the investment company, neither is the insurance company. So we are paying for these things in the end. So it's important to know what these incentives are. When you work with someone that's commission-based, you want to make sure that you ask them, like, confirm, how do you get paid? And if they're a good, honest person who's trying their best, they will tell you very clearly. And they'll even show you, like, I know with disability insurance, some insurance companies pay more commission than others. To my knowledge, and some of these people might correct me if I'm wrong, but I think that Guardian's commission rates are higher than others. And so, would they be incentivized to sell a Guardian policy to you instead of another one? Possibly. It doesn't necessarily mean that it's bad advice. You just need to make sure that you can ask them to justify why they're recommending what they're recommending. So it requires more vetting on your part during the advice process. And it's okay, that's all right, but you do have to do it to be able to protect yourself. Second type of model I think of is paying a percentage of the amount of money that you are having an advisor manage for you. This is known as assets under management, or an AUM fee. And this is a way in which an advisor, they charge you a fee that's based on how much you have invested with them. Say you've got $1 million with them and they're charging you 0.9%. So, they're charging you $9,000 per year to manage that account, right? Now, that AUM fee might be higher. I was actually just speaking with someone today who's with an advisory firm that I have no issue with. They're reputable, but they do charge a 1% fee, but what they also do is they charge an additional fee for additional services. And you're going to see some of this more and more, where advisors are trying to play the tax planning value game, and where they're like, well, we provide direct indexing, we provide tax loss harvesting, we do that, and it can be useful, it has utility. But in the case of this firm, they're charging an additional 0.35% in order to access tax loss harvesting services on their investment accounts. Now, this may or may not be of value to you personally. Not everyone needs to have that sort of a setup. It's primarily set up for taxable accounts, because if your accounts happen to endure a loss on a short-term basis, tax loss harvesting sells that lost position or that losing position. So you capture that loss, and that can either be applied against your current taxable income for the year, or it could be applied to another investment that gains, and you sell that to kind of equalize it so that you're not having to pay taxes on the profit of another investment because you sustained a loss with another one. So there can be some utility to this. Paying an additional percentage is, it's not uncommon at all. They range. I was talking with someone else today too, and they charge, I know, like Wealthfront, I think they charge 0.09% for direct indexing. So there's a range, and like what you're getting, how much it's costing you, varies. With tax loss harvesting, you got to note something too. there isn't a predictable way in which you can benefit, because you just don't know when the market's going to go down that much that it's going to be worth it to do tax loss harvesting. And and of course, as advisors, our goal is not for you to lose money, right? That's not what we want. We just want the infrastructure in place to be able to have you benefit to some degree if your investments happen to sustain a loss. So it can be a useful strategy. What it's worth paying for is another matter. So you got to be mindful of these add-on services and make sure, like, hey, if I'm paying an AUM fee of 1% and it's going to cost me another 0.35% to be able to get tax loss harvesting and direct indexing, then I got to evaluate if that's worth it or not. Under the AUM model, there are some variations. Some advisors, they just do investment management, and people come in once a year for a portfolio review, and they find out how their investments did, and then the advisor might make some suggestions, and that's pretty much it. I think it's fair to say that if an advisor is managing that much money for you, that planning, financial and tax planning, are really critical to making the most of that investment management. So if you are paying an AUM fee, make sure that you are getting proper and proactive planning around your priorities, your values, decisions that you're facing throughout the year. Because it's not just about wealth creation, it's about what we're doing with the money, what we're doing with the decisions that are in front of us to be able to make the best of our life, to mitigate stress, to support our loved ones and our goals. And that is planning. That needs to be proactive, and it's not just about how our investments are doing. Insurance, estate planning, tax planning, cash flow management, debt planning, income, business development. There's so many things that can be worked with, that can be developed in concert. And, it can be under an AUM model, with the investment accounts. That's fine. But investments are just one area of our financial life, and we don't want to give it too much importance. The last one that I think of is flat fee. The flat fee model is where instead of paying a percentage based on amount that is being invested with you or with the advisor, it's a flat fee. $5,000 a year, $10,000 a year, $20,000 a year. The services provided and the cost of that are going to vary widely. We have a range where we do one-time plans where I meet a couple times with someone. Then we have ongoing services, and that's a different fee structure. And other advisors have something similar who are in the flat fee model world. And it is nice in that it is a very clear pricing model. Just, again, you got to make sure you understand what you're getting, because it's not like, oh, flat fee is better than AUM because of the clarity. Because you got to do a couple extra calculations to get the AUM to figure out what you're paying. There is a significant contingent of people in medicine who are financial gurus who are like, oh, flat fee is better. And I don't think that's necessarily the case. I know of advisors that are in a flat fee model that have offered crummy service, or they just didn't do anything, because it all comes down to the moral character and the business infrastructure of the advisory firm and the advisor. And you can have great advisors under an AUM model and a flat fee model. You can have great advisors, even who are selling a mutual fund for commission. So you got to vet out the person and get some context around them, because it's not just the fee model. There can be awful advisors that are under the AUM model and awful advisors that are a flat fee. You don't want to give too much attention to what the fee model is. You do want to know what you're paying, but you want to know what you're getting and the quality of the person and the team around them that is supporting you. And make sure that you're getting what you need, that you understand what you're getting it when you need it, you have accessibility to them. Those are the things that really, really matter. So make sure that you're prioritizing, or that you're letting those things lead your decision on if you're going to decide to trust someone with your financial decisions. That's it for this week. Thanks for listening.